Hey, folks, welcome to the Sharing in the Disruption podcast, where we level the playing field between traditional finance and those of us who are on the ground experiencing the exponential tech changes that we're going through. We are trying to turn the perspective of the 99% of us into one that can outperform those that want to maintain the status quo and hoard wealth based on antiquated and stacked legacy systems. And personally, I believe understanding technology, all the massive changes that are upon us, a lot of things that Ark Invest talks about, a lot of things with blockchain and AI and the new version of the internet. Technology is changing so fast, and I think that the fact that we experience it on a daily basis, personally, we interact with it, get our hands dirty, that gives us a big advantage. And if we're in it for the long game, investing wise, we have so much more advantage over a trading mentality. I'll give you an example. This past few weeks, there's been a big correction in the tech market. It's been recovering a little bit, like the Nasdaq, and there's been this drop. I guess legitimately, if you are a short-term trader, in all these companies that could be affected by higher interest rates and inflation, and there's debate as to, inflation, interest rates, like nobody can control that except the Fed. That's another discussion. And interest rates, I question whether that's even going to happen. Not interest rates, inflation. I think there is already inflation in the areas that are going to experience inflation, which is hard assets, digital assets. We've seen, like during a pandemic, housing prices skyrocket. You've got Bitcoin. I think that's been eaten into gold. That's why you haven't seen that go up so much. Stocks, like you could argue that stocks are overpriced. I think it's also because there's so much money flooding into the system. And just prices of some goods are a lot higher. Art, collectibles, baseball cards, all these things people are trying to grab up right now. And that's where you're seeing some inflation. And you're also in like lumber and copper and materials for batteries. Tesla says it's going to have to raise the price of some of its vehicles. So these are macroeconomic things that are happening. But in a whole, like, I can almost guarantee you, if you buy good tech companies that are on the cusp of innovation, are pushing the boundaries of what's possible, and you hold long term, you will do very good. The people that this may not apply to, I can pretty much tell you with a straight face, you're going to do amazing if you pick good tech companies. I don't try to tell you what stocks to buy or anything like that, but you can just see how over the past 20 years, tech has massively outperformed all these kind of things that are tied to high overhead and industrials and legacy banks. All of it is being overtaken pretty hardcore. If you're close to retirement or something, yeah, you should probably put your money into areas that are less volatile. If you're not seeking volatility, don't play in the tech space. But if you need to know that your money is going to be higher in a few years when you retire, this doesn't apply to you. But I've seen my target demographic, or I've seen like the majority of people that listen to this podcast, and it's kind of in the 25 to 45-ish range. And I'm sure there's people older that get lots of value from this too, if you have some like play money and things that you can speculate with. But if we're thinking long term, these really aren't that big of speculations. So let's move on to what this is about. This is Coinbase that I'll be talking about today. Went public this past week, and for those of you living in a hole, Coinbase is a massive company that's literally come up in crazy amount of time. You have Bitcoin come up in 2009, Coinbase really started. They've been going for about I think nine years now, and it's like 1,500 employees. They at some point when they IPO, they hit about $100 billion market cap. It's fallen back since then, and they did a direct listing. And there's three different types of ways a company can really go public. There's IPO, which is where the banks are involved. It's kind of the traditional route, and they do this whole road show and like go on CNBC and do all these like and talk, and travel around and try to raise money. That's really good. I mean, it's just been used for everything traditionally, but what I believe that's still really good for is companies that need to raise lots of money, raise awareness about their company because it's just so showy. But Wall Street gets a big cut of that. Goldman Sachs, all these companies underwriting this whole IPO process, and it's just kind of like buffoonery. Sometimes a lot of money gets left on the table when they actually between like what the banks set the price at, and you have to. It's very hard if you have a company that's pre-revenue and that you don't have a good history of like showing money. That's actually where we work. There is some transparency to it. That's one of the pluses of the system. The negatives is that a lot of people dip their hands into it. They're not very understanding of like the grand vision, like with Amazon, with Jeff Bezos is trying to explain, okay, we don't make money yet, but this is the grand vision. It's not a very receptive environment to try to like make a case for how much your company should be worth. But also it does help filter out a lot of fraud, whereas WeWork got crushed when they try to go public because you have to release documentation that is very transparent, which some of the other types of going public, not so much. It's also kind of a late stage, so it tends to inflate quite a bit going into the IPO, and there's maybe more limited upside, whereas some of the other types maybe let you get in earlier but with more risk. And that's being debated about how there's this whole movement towards like not letting investors like take any risk, almost like babying them, and I'm very against that. I think you got to do your due diligence. That's what a channel like -4 is, to try to help you, but you also should do your due diligence after seeing me. I don't know everything, and neither does anybody else you're watching on YouTube. So don't take it, consume as much content, watch me, watch 20 other people, do your own research, get a well-rounded diet, balanced diet of information, and pull up some good articles, learn to read some charts, learn to research a company, look into their documents before going public, and that'll put you in a good place. So there is direct listing, which Coinbase is, where they don't need to raise a bunch of money. They have plenty of awareness. They're trying to raise money. They're trying to get a lot of liquidity too. Get onto the market maybe before their competitors. And they already have a good brand. And some of the direct listings were very uncommon until recently. And you had some high-profile companies like Palantir, Spotify. What else? There's Slack. I don't think Shopify was one. Those companies, they're well-known companies, and they just chose to do that so they could just say, you know what, this is what we're worth. Bam, going public. And usually it also involves like they can very much control like how much of their company is public and maybe only let a smaller chunk of their company be on the market now and maintain more equity. Then there's SPACs, which became super popular this past year. They're not new, contrary to everybody being like, oh, this new vehicle. SPACs have been around. They were traditionally known as something that was quite shady to be viewed at. It stands for Special Purpose Acquisition Company. Yeah, sorry, my brain just froze up. Special Purpose Acquisition Company, and it's where somebody gets a pool of money from different investors and kind of puts it somewhere. And it's a blank check company.